Welcome to the Markowitz, Fenelon and Bank, LLP video blog.
Section 179 deduction allows you to write off long-term capital assets all at once. So by way of example, typically if you're buying a long-term piece of equipment and it costs $100,000, you would write it off ordinarily over a 5-year basis, depending on the type of property it is. Section 179 allows you to write off that $100,000 all in the year that it is acquired and placed in service. So if you're a business that happens to have $100,000 of net income and you want to reduce that net income to zero, you could conceivably purchase a piece of equipment for $100,000 and your net income is then reduced to zero for taxable income purposes. It's really important to note that the piece of equipment doesn't have to be paid for in that year. So you conceivably could have that tax write-off without the cash outflow of buying that equipment. It could be financed over a 4-year period or the estimated useful life of that equipment. And you can still have the write-off as long as it is acquired in the tax year and as long as it's placed in service in the tax year, is the way the law reads. The new law has expanded the use of 179 up to $1 million. So you could conceivably acquire and place in service $1 million of equipment and write it all off in the year it's acquired and placed in service. It's a big expansion of the use of Section 179 and the amount. And basically, it's to help stimulate the economy. If businesses have the opportunity to buy long-term assets and write them off immediately, it has a stimulative effect on the economy. It allows a favorable tax treatment for that purpose. Some states recognize Section 179 and will allow it. Some states decouple from Section 179. In addition, the bonus depreciation has also been expanded to 100%. Some states also, like New York, do not recognize the bonus depreciation rules. And what this allows, it's similar to 179 in the sense that it allows you federally to write off the whole asset beyond 179 limits, but you generally cannot do that for New York State purposes. They decoupled. You'll end up with an adjustment or an add back for New York purposes, where you'll end up depreciating that asset over time, not all at once. One of the important areas in the law that has changed, and it's really spells out a tremendous planning opportunity, is in the area of commercial property and commercial real property. And in particular, non-residential real property that's in service for business purposes has the ability to potentially write off certain types of property for Section 179. It could be, in particular, items like a roof, HVAC, fire protection, alarm systems, or security systems, where in the past those types of properties were not allowed to be 179 and written off immediately. And inherently, real property, in the past, you weren't allowed to write that off, but that's an important change in the tax law. It could very well be changed. They will probably be coming out with what they call a technical corrections to the tax law, where they think about it and they issue corrections and changes and correct certain areas of the law where they didn't intend for them to allow nice deductions. So we could see technical corrections that'll adjust some of these things, but for now, there is opportunities to write off for 18 in particular, and for 19 until we see changes. certain types of property that we didn't see before. In regard to capital improvements or capital assets versus repairs and maintenance, the main thing with that is you need to look at ongoing maintenance and repairs to assets and equipment is an immediate write-off. If the assets is more long-term in nature, generally speaking, if it's going to last and be usable for more than a year, you're probably required to capitalize it as an asset. There's a lot of different tests and de minimis type rules that need to be looked at in terms of the industry that you're in, so that you can see, is it a de minimis amount or is it a significant amount? You can have certain industries, say the ready mix concrete industry. Ready mix, you might have a lot of very expensive equipment. So the threshold for writing off items as repair and maintenance might be a lot higher than certain other types of industries. It really depends on the industry you're in. If you're in construction, certain types of heavy construction equipment, you can spend an awful lot of money on repairing heavy equipment, and it would be qualified as a write-off under repairs and maintenance. If it's expected to extend the useful life of the asset and it's significant, like a brand new engine, it might need to be capitalized. But it's all relative to the industry you're in and the amounts that you spend on these items. So it needs to be looked at from the perspective of what's reasonable in your industry. You may have certain types of items on your books, and sometimes you need to be a little bit of a detective and determine what's on your books and how it is affected by the new law, and see the treatment, because it might be different than it was in the past.
Thank you for watching. If you enjoyed this video, we invite you to subscribe to our YouTube channel.